That close felt heavy from the open all the way into the bell.
At 4 p.m. Eastern Time, the Dow finished at 49,451.98, down 1.34%. The S&P 500 closed at 6,832.76, down 1.57%, and the Nasdaq ended at 22,597.15, down 2.03%.
The tape looked like one message. Investors are repricing who actually earns money in an AI-saturated economy.
A concrete trigger was Cisco, ticker Cisco, dropping about 12% after guidance disappointed versus very high expectations.
That matters because Cisco isn't a fringe name. It sits in core enterprise plumbing.
So when guidance from that layer weakens, the market reads it as a demand quality signal, not just a one-stock miss.
Then the selling spread. We saw pressure move beyond software into logistics and office-exposed real estate during the session.
Exactly, this wasn't just a momentum unwind in one pocket, it became a cross-industry disruption repricing.
One representative move there was C.H. Robinson, ticker CHRW, which fell hard as traders debated how fast AI freight tools could compress margins.
The debate is no longer whether AI is important. The debate is who captures the productivity upside and who gets commoditized.
Meanwhile, rates moved in the opposite direction from stocks today.
Right, Treasury yields eased, with the 10-year near 4.1%, as weak January home sales data and a still stable labor signal pushed investors toward a wait for CPI stance.
So we had risk-off equities, but not a full macro panic in bonds.
That combination usually means the market is questioning earnings durability more than economic survival.
Let's bring in influential voices because they frame the argument clearly.
Tom Lee said on CNBC that if CPI comes in tame while jobs stay decent, macro recession fear can keep fading.
Why did that spark debate? Because bulls hear soft landing intact, while skeptics hear good macro doesn't automatically rescue overvalued business models.
The framework behind Tom's view is top-down. Growth plus cooling inflation can support risk assets even after short-term shocks.
We also heard Jay Woods say the same AI force that pushed multiples to extremes is now holding those multiples back.
That sparked debate too, because it flips the old narrative from AI as pure expansion to AI as selective compression.
His framework is bottom-up valuation discipline. When disruption risk rises, the market cuts duration and demands proof now.
Put those together and today's lesson is sharp.
Event first, interpretation second, framework third.
The event was a broad sell-off led by guidance disappointment and contagion fears.
The interpretation is that markets entered an AI return on investment audit phase.
The framework is to separate companies by cash flow defensibility instead of treating tech as one trade.
Into tomorrow, CPI can change the speed of the move, but not necessarily the direction of this dispersion theme.
If inflation cools, index pressure can ease quickly.
But unless earnings confidence improves, leadership likely stays narrow and fragile.
That's why today was educational. It showed how a narrative transition happens in real time.
One more reminder, this is market analysis for learning and discussion.
We'll keep tracking what happened, why it mattered, and what investors can learn next. See you tomorrow.